Hey guys, what's going on? Jebb here, and in today's video, I'm going to be explaining exactly why I just invested over $20,000 into AI and memory stocks instead of betting it all on red at the roulette table. Moves like this are how I've managed to more than double and almost triple the S&P 500's return year to date and over the last month. In this video, I'll break down my recent nearly $23,000 investment in AI and the memory sector, a critical subsector of the AI boom that is experiencing massive growth because it is becoming a critical bottleneck in the AI boom. A bit of context first. In a computer, you have two different kinds of chips, your logic chips and your memory chips. Logic chips are your GPUs and your CPUs. These are the chips that do the actual work, the thinking, if you will. And the companies that make them, like Intel, AMD, TSMC, and Nvidia, have grown over the last few years to market capitalizations combined of over $10 trillion thanks to the AI boom. And that's not going to slow down anytime soon. But logic chips are only half of the equation. For a computer to function, for a data center to function, you also need memory. These kinds of chips store information before, during, and after computation, and they are vital to data centers around the world. Without enough high-speed memory chips, every single logic chip on planet Earth gets completely shut down. And right now, a bottleneck of memory is exactly what's taking place in AI data centers around the world. So before we get into the memory stock and AI stock picks that I have actually taken out positions in, let's talk a little bit first about core principles, because unlike a lot of other channels, I'm not here to hype you into an investment where you're just going to absolutely lose your rear end because you bought in at the top. Instead, I prefer to actually make money, and while I'm doing it, keep it. You see, I'm a father, and one of the things I teach my children is that the first rule of being alive is to continue being alive. And it's kind of similar in the markets. The first rule of being an investor is to continue being an investor, and that means that we can't lose all of our investing principle because we bought the wrong asset at the wrong price. At the heart of everything I do on this channel is one principle, and that is that we buy great assets at good prices. But what does this actually mean? When we're looking at stocks, we're looking for a few different things. First of all, we're looking at strong growth in the earnings. We want to see profitability, and a lot of it, and we want to see that profitability increasing quarter over quarter and year over year. This is what tells us that the market has decided that this is a great company. It's being rewarded with profit. The next thing that we want to look for are neutral to cheap PEs. Now, what's a PE? A PE is the price to earnings ratio. What is the price? What's the market capitalization of this company compared to the profit that this company is making? When you're looking at PE ratios, especially in some of these stocks that we're going to be picking, we want to be looking at PE ratios that are below 20, preferably even below 10, when you're looking at something called the forward PE. That is the forward PE based on what analysts are projecting the earnings are going to be for these companies. This helps us to ensure that even if a stock has just gone through a major rally, or even if it's just gone through a major crash, that we are not overpaying for the stock because the earnings are strong compared to the market capitalization of the company. This is one of the cores of how we do fundamental analysis on stocks, especially stocks that are in explosive growth. Because today, as I show you some of the charts of some of these stocks, you're going to look at them and say, Jebb, why in the world would you buy that? It's already moonshot. But we want to remember, we're looking for stocks that have great forward PEs. And these stocks, even though they've already seen major rallies, are actually still undervalued compared to what they should be valued at based on their PE ratios. We also want to look for companies with strong moats. Now, what's a moat? If you have a castle and you're a king and you want to protect your castle, you're going to tell all the townspeople to get out there with shovels and dig a moat around your castle. It takes a really long time to dig out the moat, and it takes a really long time to fill in the moat, to get across the moat, to besiege the castle. And companies with great moats do something like this. Amazon's a great example. They've spent $10 trillion on a distribution network. Nobody can compete with Amazon because nobody can come up with $10 trillion to build the same distribution network that Amazon has built. And so they don't have many competitors because nobody can really afford to play in the same league as them. They have a great moat. And so when we're looking for companies, we want to look for companies with durable competitive advantages that are not going to easily be able to be competed with. All right, so now that we've got some of our core principles out of the way, let's talk a little bit about the memory stock thesis and why I've taken out investments in these positions. From a principled standpoint, I look at it like this. If the world demands AI, and AI demands chips, specifically logic and memory chips, then whichever one of those types of chips are in shortage are going to see a massive and violent repricing until the bottleneck has been resolved. And right now, memory delivery to customers is clearly lagging behind logic. Logic chip leaders like Nvidia, Intel, TSMC, and AMD have already seen enormous re-ratings. They've gone on massive bull markets as a result of them being the bottleneck. But memory companies, they're still playing catch up. They have not yet seen the massive and violent re-rating that their stock prices should have as a result of the bottleneck that they are addressing. Just look at what the CEOs in the space are saying. Micron CEO Sanjay Mehrotra has been very direct. The company can only meet about 50% to 2/3 of demand from key customers, and supply will remain substantially short of the demand for the foreseeable future. Micron's entire high bandwidth memory production capacity for 2026 has already been sold out under binding long-term contracts, with tightness expected to persist through 2026 into 2027. And although the contracts have been signed and the memory is guaranteed, the revenue has not yet been received, and you can't get out of the contracts. It's guaranteed revenue. Going back to our principles, this helps us to understand that the forward PEs on Micron are trustworthy. Samsung and SK Hynix, the other two major memory producers in the global triopoly between Samsung, SK Hynix, and Micron, are echoing the exact same message. Samsung's memory chief Kim Jae-joon recently warned of, quote, significant shortages continuing through at least 2027, with customers already pre-booking capacity for 2027 and beyond. SK Hynix has similar warnings. High bandwidth memory demand is exploding, and supply is essentially locked up years in advance. On top of that, AI data centers are projected to consume up to 70% of global memory production in 2026 alone, creating an unprecedented structural imbalance. The memory supercycle is here. This isn't just speculation. It's supply and demand meeting at an attractive valuation with strong, visible earnings. These principles are exactly how I've managed to more than double the S&P 500's performance year to date. They keep me disciplined, they keep me focused on long-term compounding growth, and they keep me focused on great companies at good prices. With that foundation in mind, let's dive into my individual investments and the rationale behind each one of them. So as I said, I'm going to run through each individual investment, why I've made it, and how it plays into the overall memory and AI thesis. And by the way, I'm going to show you a screenshot of my exact brokerage account towards the end of the video so you can see my exact positioning, my exact cost basis, and my exact return down to the penny. To begin, I made an investment in VU and QQQ. These are some of the indexes that I would like to build a position in our brokerage account because they track the overall S&P 500 and they also track the overall tech sector. You can see I've not invested very much in these because I want to focus on growth as I'm getting this portfolio up towards 100,000, 250,000, 500,000, and even up to $1 million by our target date of 2030. These are core positions that if I have an absolute moonshot in a different position, I may take profits and dump into these positions. These are long-term, forever hold positions, and they do capitalize on the AI growth because the AI boom is causing growth in the underlying indexes, but they're not going to capture as much of it as I would like, which is why we have more concentrated plays coming up. We've also made some specific plays in AI rather than just memory because we don't just want to capitalize on memory, we also want to make sure that we're benefiting from the overall sector. Microsoft is a great example. Of the Mag 7, Microsoft has the lowest PE ratio right now. Forward, it's around 22 to 24, depending on the exact price. And part of the reason that I've invested in Microsoft is because of those Mag 7, it is the one that is closest to its longer-term averages. When you're looking at these hyperscalers, it's a little bit more difficult to find one that has a very low PE like we're going to find in some of these single stock plays. Instead, we're looking at long-term technicals. And in this case, Microsoft is one of the few hyperscalers of AI that is sitting on its 200 weekly simple moving average right now. Google, for example, while it is a fantastic company, is very far away from its 200 weekly simple moving average. And so although I would like to buy it at some point in the future, its elevated PE and its distance from its averages makes it difficult for me to acquire it at these levels. Meta is looking attractive with over 3 billion customers, but is still a little bit far away from that 200 weekly simple moving average, and it didn't respond very well to very bullish earnings reported a couple of weeks ago. The final one of the big names would be Amazon, and again, although Amazon is a fantastic company, it is still not exactly what we would call cheap. So Microsoft is our play here for investment in AI hyperscalers, and if any of them end up looking like a great deal at some point in the future, again, according to our principles, then we will load into them as well. Back to our individual holdings, we have also taken out a $2,000 position in SOXL. Now, SOXL is a very aggressive play on AI because essentially it is a 3x leverage play on the SOX semiconductor ETF. The SOX semiconductor ETF, the unleveraged version, ever since the bottom of the tariff crash down here in 2025, is up 235% because it tracks with several dozen of the largest AI names like Micron, Nvidia, TSMC, etc. I expect the AI boom is nowhere near over, so I've decided to take out about 10% of this new investment in SOXL, which again is a 3x leverage version of SOX. It is up 268% in the last 35 days. Now, the thing you have to understand about investments like this is that on the downswing, it could drop 90%. So you don't want to put your overall investment in SOX because, again, it is leveraged, but considering the growth that we're going to see in AI over the next couple of years, I actually think that $2,000 position will perform quite handsomely. I've also invested $1,000 in each of the two biggest names in chips, which would be Broadcom and Nvidia. Starting with Nvidia, the reason that we've done this is because Nvidia is one of the blue chip names. They make about 80% of the GPUs that are necessary for AI data centers, and they are almost guaranteed to see massive growth over the next 5 to 10 years as the AI boom continues to accelerate. Broadcom specializes in the supporting infrastructure that are needed in data centers. When you look at the way that the GPUs connect with each other, Broadcom is the premier company in this space, and our investment in Avgo has already performed quite well. Now we get down to our actual memory plays, and these are the ones that I believe are going to perform exceptionally well, and I'm very excited about them. Our first investment has been a $1,000 purchase of Sandisk. Ever since we've made this purchase at an average price of just over $1,000 a share, it has absolutely moonshot, and there's a very good reason for that. Sandisk right now, depending on how exactly you calculate it, even after this massive run that I just showed you, has a forward PE of about 8, not 20, not 25, not 30, not 800 like Yahoo was at the top of the dot-com bubble. 8. This is driven by the fact that Sandisk has a market capitalization of only about $200 billion and quarterly revenue of about $6 billion, with $3.6 billion of that being net income. This is almost 300% year-over-year growth with a 60% profit margin. This is why over the last 6 months, Sandisk is up 535%, and that forward PE is why that's probably going to happen again in the next 6 months. Sandisk has a very real possibility of going to $500 billion to $1 trillion of market capitalization if it can continue growing revenue the way that it has. At this rate, Sandisk could be seeing $10 to $30 billion of profit every quarter within 2 to 3 years if memory demand keeps up. So again, you think to yourself, Jebb, aren't you a technical analyst? Why are you buying an asset that's already done this? Because Sandisk has absolutely gone ballistic. Weren't you just talking about the 200 weekly moving average? I mean, the 200 weekly moving average isn't even visible on Sandisk because it only spun off from Western Digital like a year ago. Yes, that is true, but what you need to understand is that when you're looking at stocks, you need to focus on the PE. And the fact of the matter is, Sandisk has continued to grow revenue and profit and is probably going to continue doing the exact same thing because of their play in memory. And this is why we took out a $1,000 position in Sandisk and why it has already grown over 25% since I bought it on Friday, like 4 days ago. Next, we get to the largest play in this overall round of investment, which is Micron. And I have invested $7,500 into Micron. Here's exactly why. Let's go back to our principles. We're looking for great companies at good prices. Is Micron that? What you're going to find when you do the actual research is that high bandwidth memory, that memory component of the chip's necessity that AI data centers demand, is dominated by a triopoly. There are 3 companies that produce well over 90% of the memory that is necessary for AI data centers, and those 3 names are Samsung, SK Hynix, and Micron. Samsung and SK Hynix are South Korean names, which make it very difficult for US investors to buy them. And they themselves, as we'll talk about in a minute when we talk about EWY, are massively undervalued. Micron, of the 3 names in this triopoly, is the only name that is an American-based company. The reason that's so important is because our government has made it very clear that participating and dominating in AI infrastructure is a matter of national security, which means that when you look at Micron, you realize that it is very quickly becoming one of the most valuable strategic assets to the entire global economy. And therefore, it's going to get all the support that it needs from the federal government. Micron has already seen all kinds of investments, starting in the CHIPS Act several years ago, including loans and different kinds of support that the U.S. government has been giving to it. And as you can see from this chart, between 2024 and 2025, Micron tripled market dominance in the high bandwidth memory department, taking from the likes of Samsung. On top of that, even after the recent run on Micron, we still see that Micron is only sitting at $720 billion in market capitalization. This is based on a 57% profit margin, $13.7 billion of profit in quarter 2 of 2026, and revenue totaling almost $100 billion in annual revenue. This is a growth rate several 100% strong, and Micron is expected to continue this. Remember what I said earlier, Micron's contracts are legally binding. They cannot be gotten out of by the data center companies, these hyperscalers that need the memory, and the revenue has not yet been received. So we actually know how much revenue Micron's going to make for the rest of the year because they've already sold all of their production. And we know that Micron, again, under legally binding contracts, is going to make between $60 and $100 billion in top-line revenue, probably at about a 50 to a 70% profit margin for the rest of the year. Again, can't stress enough, that's contractually obligated, it's legally binding, and all of their production's already sold out. So Micron is basically guaranteed to make probably somewhere in the range of $50 to $100 billion in profit this year, and their market cap is only $700 billion. Remember what I said before, AI demands compute. Compute demands logic chips and memory chips. Nvidia is the American leader in logic. Micron is the American leader in memory. They're both equally important. Without memory, data centers don't work. Without GPUs, data centers don't work. But Micron, the American leader in memory, sits at $720 billion in market cap, but Nvidia sits at $5 trillion. But now compare the revenues. Micron is slated to earn about $100 billion in revenue this year with about a 50 to a 60% profit margin, and they're only worth $700 billion. Nvidia, on the other hand, is worth $5 trillion and is expected to earn about $220 to $250 billion in revenue with 50 to 80% profit margins. Relatively similar profit margins. Nvidia's got about double the earnings, about double the revenue, but almost 10 times the market cap. Do you see the imbalance here? Do you now understand why Micron is going up into the right? And do you now understand why it's not going to stop anytime soon? Micron, within the next month, is probably going to be $1 trillion company. It's probably going to add well over $100 billion of valuation each month for the rest of this year. There is a very high likelihood that Micron, being the leader in American memory, is going to be a $2 to a $5 trillion name by the end of this decade, similarly to where Nvidia is right now. Now remember, Nvidia is the leader of logic chips. Logic chips are always going to command higher market dominance because they're not as cyclical and they frankly do cost a lot more. But memory should be at 50 to 70% of what logic chips demand. And Micron, once again, is the leader there, which means that $700 billion of market capitalization simply is not fair. And the fact that it's undervalued and the fact that the forward PE ratio is like 6 right now, as opposed to Nvidia's 26, is exactly why Micron is rallying so hard and why I took out a $7,500 position in it. All right, now I also want to talk about our $2,800 position in DRAM. This is a new ETF that has been exploding lately, and it tracks 3 major names. Over 75% of DRAM is invested in Samsung, SK Hynix, and Micron. As you can see, DRAM holds 25% SK Hynix, 21.6% Samsung Electronics, and about 22% Micron Technologies. It also holds many other memory names like Western Digital, Seagate, and Sandisk. DRAM, ever since its inception a couple of months ago, has been basically vertical up and to the right, and that's because it broadly tracks the entire memory sector globally, not just the American component of Sandisk, Western Digital, and Micron, but also the South Korean sector, which is Samsung and SK Hynix. This ETF will most likely go to over $200 per share because of the growth in the underlyings that we just talked about. That is specifically why I took out a $2,800 position in DRAM over the last couple of weeks. Finally, I've also invested $2,000 in ticker symbol EWY. This is a ticker that basically tracks the South Korean economy, mainly Samsung and SK Hynix. The reason that I've done this is because the vast majority of EWY is invested in SK Hynix and Samsung Electronics at 24 and 22% weightings respectively. Now, the reason I haven't invested more here is because I actually don't want a bunch of investment in the South Korean economy. That's not what I'm going for. I'm actually going for direct investment in Samsung, SK Hynix, Micron, and Sandisk because they are going to be the biggest beneficiaries of the memory play. This brings our total invested between all of these different plays that we've made to about $22,300. And you can see those investments right here in a screenshot of our portfolio. You can see the $1,000 cost basis on Nvidia, the $1,000 cost basis on Avgo, on VU, QQQ, Sandisk. You can also see the $2,000 cost basis on SOXL, the $2,000 cost basis on EWY, the $2,800 cost basis on DRAM, the $3,000 cost basis on Microsoft, and also the $7,500 cost basis on MU. As you can see, even just today, all of our brokerage account is up 2.3%, and it's up about $1,500. And you might think I'm crazy, but I actually genuinely expect that performance to continue for quite a while. It's going to take 6 to 18 months for the memory sector to catch up with the logic sector because it's just so massively undervalued. What a lot of people don't understand is that we are still in the early days of AI growth. The AI sector, the AI boom is nowhere near done. There is structural, real demand. And to the idea that this is the dot-com bubble, in the dot-com bubble, you had companies like Yahoo and Cisco trading at 200 to 800x forward multiples. They had massive valuations and no money coming in. That's not what's happening right now. Even the big players that are running at high premiums are running 20 or 30 forward. Intel, of course, is running at like 100 forward. Tesla's running at like 170 forward. And those are high, which is why we haven't bought them. But many of these names that we're talking about, although they've already gone on massive runs, those massive runs are driven by real structural demand. In some cases, structural demand that is legally binding for at least a year out. Micron, for example, is expected to rake in over $150 billion in top-line revenue, probably at least at a 40 to a 50% profit margin for years to come. Now, something you need to understand is that memory is cyclical. It booms and it busts. It's kind of like Bitcoin. But this seems to be a supercycle. Just as I said, this seems to be a memory supercycle, and it seems to be here to stay. The structural demand for memory is not slowing down anytime soon. And that's why we've taken out these positions to capitalize on it. Because as you guys know, we have a goal on this channel. We're trying to reach $10,000 a month in passive income by August of 2030. And some people in the comments have rightly pointed out, well, Jebb, why aren't you investing for growth? Why are you only investing for income? Why don't you capitalize on some of the growth that's going on? So that's exactly what we've done. Over the last month, we have taken our brokerage account from about $30,000 in valuation to about $65,000 in valuation. I'm targeting hitting about $100,000 invested there over the next couple of months, and I'm targeting hitting about $150,000 to $200,000 invested by the end of this year. And I'm also adding to the goal that we're going to be tracking on this channel. I would like for our brokerage account to hit $1 million liquid by August of 2030. If this is the first video of ours that you're watching, we have a goal on this channel of reaching $10,000 a month in passive income, and now we're adding to that of $1 million in our brokerage account by August of 2030. That's the month that I'll be turning 30. I'm 25 right now. By the time I turn 30, I would like to have so much passive income coming in, so much growth coming in, that we can live off of our investments and invest all of our earned income to generate passive income, and then our family, my wife and I and our 3 kids, hopefully more than that by then, will have passive income flows that we can live off of, and then at that point we're work optional, and we're just going to continue going out here and trying to help you guys however we possibly can. Right now, our brokerage account is sitting at about $65,000, and we're bringing in about $700 a month in passive income. If you factor in the income that's coming in from our high yield savings account, then we're looking at about $1,200 a month in passive income right now. So listen, if you've enjoyed today's video, I want you to do a couple of things for me. Number one, hit the like button. Let's see if we can't get to 1,000 likes. That lets YouTube know that you like the video and that more people should watch it. So if you got value, the best way you can tell us that is by hitting the like button to communicate to the AI behind YouTube that the video is good and it should be pushed out to more people. The second thing you can do is you can hit that subscribe button and stay tuned for more content. And the third thing you can do is you can check out some of our recent videos. We just interviewed David Nicholas, the founder of the Blocks ETF, and he announced in our interview that he's going to be launching a memory-based income fund. So make sure to go and check out that video with the card right there. After you do that, make sure to go check out our video that we uploaded recently where we talked about why we sold all of our SPY-I and invested in XQQI and increased our annual income by almost $1,500 a year. I really appreciate you being here. Tell me in the comment section down below if you are taking out some of the similar plays that I've made. Nothing I've said here is financial advice. Please do your own thinking for you. And before I go, I do just first want to thank each and every single last one of you for watching, as always, and I will see you guys in the next video. Peace.